Good evening, members. Apologies for the delay. Welcome you all to the CPA session on Form GSTR 9 and 9C, process analysis and important pointers. For today's session, we have C. Akshay. I request our Vice Chairman of Bangalore branch, Manjuna Tembalu, to escort the speaker onto the dais. And welcome you to the oral booking. Akshay qualified as chartered accountant in 2016. He is a DSA qualified professional. He has experience of over 3 years in internal audits, compliance and assistance. And with respect to indirect taxes, he has over 7 years of experience. He has headed the GST impact assessment of various industries such as automobiles, software, manufacture, logistics, retail, construction, education, etc. He has also undertaken GST trainings for corporate clients and has been invited by various professional communities as speaker. He has co-authored the book Guide to GST Compliance Review with GSTR 9 and 9C in 2020-24 and Due Diligence under Indirect Tax booklet issued in May 2021. He is a regular contributor to GST articles to KSCA, Tax Sutra, CA Club India, Tax Sutra and Mangalore SCM. With this brief introduction, welcome you, Akshay. Over to you.
Good evening, members. Welcome you for this study circle meeting on GSTR 9 and 9C. What are the checkpoints for preparedness to departmental proceedings? Before the speaker starts, a couple of caveat points I thought I'll just brief you. Have a thorough working papers for GSTR 9 and 9C. Have justification for all the reconciling items. Have clarifications ready, recorded somewhere, and by playing devil's advocate as if, what if you get a notice from department, right? And I request all members to take utmost care while doing GSTR 9 and 9C because it's only a matter of time. You might have to apply for the notice in this regard for your clients. So in very near future. So have those clarifications what you think that department would come and ask for. With that note, I once again welcome C. Akshay to develop on the subject. Before the
on the 990, how we can be prepared. Additionally, this time we have added the concept of departmental preparedness. The issues which are being raised by the department on GST presently is majority on the basis of incorrect reconciliations or inaccurate data which is there in their systems with respect to reconciliations. The conceptual issues which are being raised are far few than what is expected. Keeping that in mind, reconciliation issues are also being raised with respect to GSTR 990. In this PPT, I have written departmental issues and solutions. I have given 2 or 3 slides only on departmental issues which they are raising. The bigger focus is on what we can do on a proactive basis, which is how can we prepare the GSTR 990 in the correct manner with all the correct disclosures, with even additional disclosures more than what they are asking us to perform in the GSTR 990 to ensure that we do not receive any notices for our clients. So keeping this in mind, I will start my session. If you have any doubts, any clarifications, if you feel I am wrong in one of the disclosures, because 990 till date, the instructions the way they have been given, they have not been very clear. They have just mentioned that you can take the data from here, you have to fill this data here. The permutations and combinations which arise on a practical basis are not covered in the instructions to the form. So there may be different ways of filing the GSTR 99C. It may be a right way. It need not be that there is only a single right way of filing the 99C. So what I would disclose is the way that I file the 99C, and maybe some certain permutation combinations which may arise for specific important transactions. So if you have any clarifications, any doubts, if I have put up anything wrong also, please do bring it to my notice and we will take it right away. If we do not discuss that point then and there, it will be tough for others to recognize which point they are speaking about at a later stage. So, in the anatomy of the GSTR 9, what does the department expect the taxpayer to update? If you see part 1, it's basic information that gets auto-populated. Part 2 is our outward supply, which relates to all transactions of outward in nature, including my RCM transactions. The requirement here in 2017-18, when the form came out, it mentioned that the data is supposed to be auto-populated based on returns filed. So whatever you had filed from July 17 to March 18, it was supposed to be auto-populated and disclosed in GSTR 9. There was no option to amend initially. After that, department and the government realized this is not possible, this is not practical. They gave the option to make changes in the GSTR 9 manually. To this end, they modified the instructions to the GSTR 9 saying, in the paragraph 4, they have said that if there are any transactions, in transactions they mean your liabilities, which have not been disclosed in GSTR 1 or 3B for the financial year, it can be disclosed for the first time in GSTR 9. And to this end, all of us are very aware that this is a self-assessed return. This is not based on a departmental order or a demand. And therefore, once it's a self-assessed return, whether in your 1 and 3B, if the department in the future raises a condition that you cannot pay tax using your credit, it is already there for certain classes of industry, certain classes of transaction. But if this is made as a standard process that you cannot use your credit to pay tax, the effect of the indirect tax itself is diluted. So there is a provision in the instructions to the GSTR 9 and even the 9C. It says that any additional liability has to be paid in cash only. Now keeping that in mind, is that fair? Any idea? Should we follow the only cash concept? How many are following only cash concept, can I see, when they make liability payments through GSTR 9C? Anyone asking clients only to pay in cash? No, right? So this is the right approach. We should not pay in cash. If we are able to utilize the credit and we have the credit balances available, we need to see if we can utilize the credit also. This option is also backed by the GST portal. The portal also allows you to use the credit. Of course, if you have RCM liability, don't use the credit because it is to be paid in cash. So the intention is to disclose the outward supply as per the books. That's why I have displayed outward supply books. But for part 3, which is in relation to ITC, I have mentioned GSTR 3. Again, in this part 3, there are 2 tables. One is ITC claim and the other is ITC reversal. ITC claim is based on GSTR 3B only. Various case laws have come up in the recent past which have clarified that ITC must be claimed in the returns. Unlike the erstwhile regime, if it is there in the books, we cannot say that the credit is eligible because it was there in my books. I missed to claim it in the returns. That position now is covered in the GST law. Therefore, credit claim must happen only through the returns. What is missed to be claimed in the returns, GSTR 3B, is now lapsed. Keeping that in mind, the next table, which is ITC reversal, that follows again the book basis, which is your ITC reversal. So what the department is saying is, you need to disclose any form of additional liability in the GSTR 9, but if you have missed out any claims, you cannot do it through the GSTR 9. So keeping this information in mind, this is the basis of preparation and the anatomy of this return. In part 5, you have another set of important transactions, which are transactions of the present year, which are disclosed in the next financial year. Other details more or less are optional and not mandatory other than the HSN output table. We will come to that. What is the statutory requirement? GSTR 9 needs to be filed for those persons whose aggregate turnover is more than 2 crores. This must be seen on a pan level basis, and for 9C the limit is 5 crores. So those between 5 to 2 crores need to file only GSTR 9. Beyond 5 crores have to file both these returns. Next, I have provided a list of pointers which is useful for most of us here, which is the management report, which is not mandated by law. This is something which is given as a best practice, which is useful not only for the client but also for us. So in the present day and age, if you see your client's attrition rate, if you see your own attrition rate, you may see that the person who has worked on 2017-18 9C is not no more in the office. Similarly, in the client's place also, the person who worked on 18-19 is no more in their office. Which means yourself and maybe the tax head or the CFO of that entity are the only two people who are aware that this activity was done by your office. Naturally, he is going to ask you to explain. Can you explain all your GSTR 990 of 17-18-18-19 without having a comprehensive working file? So this working file which we have mentioned, what all it must contain, and this is made into a form of a report where you get all the reconciliations which are listed, outward, inward, RCM. Other than this, I have given very separately a reason for variance. Reason for variance, the reason I have kept it separately is because I do not intend to match everything to nil. It can be that there is a variance for some values in the GSTR 9 with respect to outward, RCM or inward, but there is a reason for this variance. We need to only ascertain whether the reason is logical and can be explained by way of future workings, whether it is paid in the future returns, as a DRC 03, or some other adjustment which was done in the books of accounts which can be disclosed by showing them the books of accounts. So reasons for variance: additional liability should be separately maintained. DRC 03 filed for additional liability. The number, DRC 03 number, if you use credit, there is a I which comes. If you use cash, C comes. So you can also identify based on the DRC 03 reference. The document number can be also put into your working file. Other than that, because the ITC now has been under heavy stress in the GST period, what they are asking us to do, they are asking us to see the permanent reversal, temporary reversal, keep it as a balance, claim it whenever the entry is coming into my GSTR 2B. Although this is a very big hassle for the clients, this is something which is implemented. So we need to also have this detail. What is the deferred ITC as on 31st March 2024? What is the deferred ITC which was pending for the period? After that, what action has been taken also can be mentioned. Automatically, we will have invoice level details of these transactions. After this, we will be able to provide suggestions on internal accounting processes which we have identified which could be improved. RCM entries, how is RCM entry passed? RCM entry is passed separately. Expense is debited. After that, RCM entry is separately made. How can I match the RCM entry to the expense? No link. So this is one internal accounting, simple accounting process that we can ask them to modify. All the credit and your liabilities are into a single GST ledger. One CGST ledger, one AGST ledger, one SGST ledger. All the credits come into it, all the payables go out of it. It is a complete mess. Which is deferred in that, which is not deferred, none of that is traceable. Now this is again a process correction. Now many cases we can give these suggestions to our client. Many cases we are doing the accounting, we ourselves can implement these corrections and ensure the correct documentation in the first instance. Similarly, as we go forward, we can come up with various forms of suggestions. What the requirement here we are talking about, management report by a chartered accountant having all these details in a single working file for a single GST number. is very vital for the client. I have heard back from many of our clients who are saying that when they are having the departmental notices for those financial years, they are not even looking at their files. They are using this file and they are going and showing this to the officer, and the cases are getting. So client satisfaction is very high when we are providing this very detailed document. Coming to various important reconciliations, yes sir. Yeah, so sir, the question you have asked is schedule 3 items forming part of the turnover. With the schedule 3 items, it's beyond 5 crores. Without the schedule 3 items, it's below 5 crores. Should be filed in NC. So aggregate turnover definition in the GST law specifies goods or services forming part of the turnover, and then it includes taxable, exempt, and even non-GST. Non-GST forms part of this list because it is forming part of the exempt supply definition. So keeping this in mind, schedule 3 items can be kept outside the purview of the aggregate turnover. Aggregate turnover is linked only for goods and services turnover which is being provided. So we can keep it out of that and then compute. Now the difficulty which arises is many taxpayers are disclosing the schedule 3 turnover in the valuation or in the GST returns while they are filing. Now for example, a real estate person is disclosing the land value also while showing his GSTR 3B. He is showing that a non-GST supply and he is filing the return. In the GST portal, his turnover is more than 5 crores now. In the system now, he is mandated to file GSTR 9C. Even though ideally he is not required to file 9C, system now is mandating him to file 9C. If he does not file 9C for that period, he has to pay late fees, and next year's returns will be blocked until he files his GSTR 9C. So the disclosure is very important here in the GSTR 1 and 3B, but theoretically not. So now we come to various reconciliations which would be vital for the taxpayers to keep before filing the GSTR 9 and 9C. We have on turnover which is matching the audited financial statements turnover, total revenue, keeping the operational and the non-operational revenue. Total of this revenue must match the table 5A of all my GSTNs put together. If I just total all of them, it should match to my AFS total revenue. There should not be a variance. Many times we have seen the table 5A is being modified and then updated, and then separate modifications are being disclosed in the subsequent rows below. This is not a correct approach. Showing table 5A in the right manner is by showing the total of the turnover which matches to my AFS. If you have a single GSTN, then that should match to the AFS value directly. Next is the table 5A versus table 17. So this is my outward supply matching to my outward supply with the HSN details. Ideally, both the information has the same details. Only thing it is bifurcated on a rate wise on HSN basis. But there are few changes, if I can say, in the HSN values. First of all, HSN value need not consider my advances, but table 4 includes advance values. Next, you have non-GST supply in the GSTR 9 format, which as part of the instructions gives me a requirement to also put the schedule 3 items in the non-GST supply in GSTR 9. So to this effect, non-GST items will not have a HSN number. Now for example, land. Anyone knows land HSN? Is there HSN code for land? The answer is no. It's not a goods, it's not a service. So to this extent, we should not include schedule 3 items while disclosing our table 70, but it does form part of my table 5. So there could be certain reasons like advances and non-GST supplies. Otherwise, table 5N plus 10 minus 11. Table 10 and 11 is your part 5 disclosures, transactions of the financial year shown in the next financial year. So these also must be considered for the purpose of this internal reconciliation. Is this mandated by law? Again, no, not mandated by law. But this is something that we must ensure we are disclosing in the correct manner. If we are showing a HSN which is higher than what I have disclosed outward supply, department on that basis will tell you have made the supplies, you only have disclosed the HSN, pay the taxes for this. Alternatively, if you have shown in the other way around where the transactions are higher in table 4 and 5 but not in table 17, there they could raise the issue that you have not disclosed table 17 correctly and I will raise the general penalty for non-disclosure. Next comes our outward tax reconciliation. Most of the taxpayers are ensuring outward taxes are reconciled very well presently. GSTR 1 is matching to GSTR 3B in almost 95% of the cases. And to this extent, GSTR 1 is being filled based on the books of accounts. The only difference is where persons are using tally, where persons are having backdated entries, the transactions get into a difficult tracking mode. And this leads to incorrect disclosures in the GST returns. And alternatively, if those persons who are enabling cutoff dates in their books of accounts, filing the GSTR 1 based on finalized books for the month, and also doing a reconciliation with the e-invoice report, these persons will not face any issues in the future. E-invoice, as all of you know, now there is a 30-day time limit for raising the e-invoice, and they are slowly reducing the turnover limit for those persons for whom this 30-day limit is applicable. So to this extent, these reconciliations become very important. Having e-invoice reconciliation to books and books to GSTR 1 workings will then ensure GSTR 3B is filed correctly. How many are aware that GSTR recently came out with an advisory saying that GSTR 3B outward will be locked from January 2025? By show of hands? Yeah. So many of us are aware they are going to lock GSTR 3B. GSTR 1 plus 1A is going to be considered for that month. If you have made any error in filing the returns for that period, it should be then corrected in the subsequent returns. Outward taxes rate-wise liability. Again, I have provided a separate list for this. Reason being, in GSTR 9C, there is a requirement to show rate-wise outward supplies and even the SCM supplies. This requires internal tracking of outward taxes, and it should not be based on GSTR 3B in the GSTR 9C. So if we go back to this sheet, if we are disclosing the outward taxes based on books, automatically the first checkpoint which happens in GSTR 9 is in part 4. In part 4, you have details of tax paid, and this tax paid is arising out of the GSTR 3B. This is auto-populated data which cannot be edited. Which means if I am putting the data which is lower than GSTR 3B. So if I have filed for the year 3B say of 100 rupees, I am showing in as per books my liability to be 80 rupees. In GSTR 9 table 9, which is the part 4, there will be a excess paid disclosure, that is tax payable is lower than tax paid. When we come to GSTR 9C, I will match 80 to 80 and it will get closed. What happened to that 20? Maybe you may need to go for a refund. How can I prove that I need to go for a refund? This disclosure itself. If I show my disclosure as per the books, I can show 80 in part 2. In part 5, I am clearly providing a difference between tax payable and tax paid. This is a basis for my refund application. This is possible. But refund application is separate. Yes. Sir, the mic will be passed on at the end, it seems. So I'll take the questions at the end. Okay. So coming to the rate-wise liability, we need to fill GSTR 9C based on the books of accounts. There is a general practice that GSTR 9 is based on GSTR 3B and 9C is based on the books. Therefore, 9C versus 9 is books versus GSTR 3B. This is also an acceptable way in filing the returns. Alternatively, your additional liability, we can also show it in 9 or 9C. Closing balances of the credit. In the books of accounts, closing balance of credit will have a single transaction, whereas GSTNs may be multiple. So bifurcating the closing balance and ensuring this tracking is maintained is also very vital. This is more a neglected aspect because in GSTR 9C, the requirement of ITC matching is based on total credit claim. It is not based on the closing balance. But what closing balance ensures is that your internal controls are working fine. Your accounting is happening correctly based on what you are purchasing, selling, utilizing. All these aspects are being taken care when we are doing a closing balance reconciliation. Verifying spillover transactions, very vital for my part 5 disclosure. Transactions of 23-24 disclosed between April to October 24. This data has to be disclosed in my part 5 of my GSTR 9. Having a separate invoice level details of these transactions will help me even when I am making my GSTR 990 for 24-25. So we will get into the clause-wise analysis of GSTR 9. There are certain amendments for the past. I will skip them because more or less we are aware. It's been continuing for the last 3 years. What are the recent updates in the GSTR 9? Table 4G1 and Table 5C1 have been added to the portal, where these are transactions in relation to e-commerce transactions which are under section 9.5, where the e-commerce is liable to pay tax under section 9.5 instead of the supplier. Please note, section 9.5 is not a reverse charge transaction. Section 9.5 is only a transaction which pushes the burden of tax to the e-commerce, but e-commerce is not the recipient of the service of the goods. E-commerce is only a via media, he is an intermediary. The final customer is someone else. Therefore, calling section 9.5 a reverse charge transaction is not appropriate. This is very vital when we come to 9C disclosure. To enable this, there are some transactions. So 4G1 must be disclosed by the e-commerce operator where he pays the tax. 5C1 is to be disclosed by the supplier to the e-commerce operator where he would not be paying any tax. Words and formula changes have been done to enable this change. Other than this, the biggest change which has come in GSTR 9 is Table 8. Table 8 reconciliation requires me to match GSTR 2A to my GSTR 3B detail which I am disclosing in GSTR 9. ITC claimed in 3B, I need to match it now with GSTR 2B. This change came from anyone? 2B matching requirement, from which date it has been made mandatory. Sorry. First, yeah, so Jan 22 is the right date. First Jan 2022 is when Section 16(2)AA came into force. Before that, Rule 36(4) was there, but it did not have any authorizing act. So what this means is GSTR 2A can be challenged legally. The implementation of it, although they have brought in 2 circulars for the past periods where they are asking you to get certificates to prove the eligibility and the genuinity of the claim. From Jan 22 onwards, there was a requirement to match based on GSTR 2B. That means financial year 22-23 also was to be matched based on 2B, but GSTR 9 for that period required a reconciliation with 2A. So a lot of people had difficulty and maybe many people did not even match with GSTR 2A. Now when we are standing at financial year 23-24, Table 8 requires matching with GSTR 2B. They have bought the format of GSTR 9 in line with the law which is there presently. this may give a different outlook for the tax authorities. Earlier, Table 8, which has this reconciliation process, was not being filled with any gusto by any taxpayer. They were using it as a balancing figure kind of table where all kinds of data was being pushed. Even if it was negative, they did not care. Because there was a press release in 2018 which said that data which is shown in Table 8 is only for the information and intimation of the departmental officers. Your credit ledger will not be touched and there will not be any impact on your credit ledger directly based on lapsed credit that you show in Table 8. So based on this press release and based on the fact that this Table 8, 2A and 3B matching was not mandated and there was ambiguity, there was a lack of interest in filling Table 8. Now, as GSTR 2B is enabled and now the form GSTR 9 also is brought in line with 2B, I feel Table 8A, 8B, 8C, 8D and then 8E and 8F, all these rows have got a new meaning from this financial year onwards. Department may be taking these tables a little more seriously. So in this PPT, I am assuming that this PPT will be shared to everyone who have registered. I would not go through the specific clause wise because if I do this, it takes me about 4 hours. I will speak on the possible additional tips which may arise in these tables. If you are having any doubts, please note them down because they have informed me that the mics will be distributed at the end. First and foremost is the e-invoicing reconciliation. Now, what are reconciliations or tips that I am providing is not mandated by law. These are only things that we have identified as best practices while performing the services. So, first and foremost, e-invoicing verification. This can be done for Table 4B, C, D, E, I, J. Very important. In this, we also have Table 4I, J, K, L, which is in relation to credit notes, debit notes, and amendments. All of these are mandatory presently. We have seen a lot of taxpayers who are still clubbing entries in B2B, who are clubbing entries in deemed exports and SCM. No more is this acceptable. These are mandatory. These were mandatory from 21-22 if I am not wrong, and they still remain mandatory. The GSTR 9 for the outward supply with taxes. Only in this Table 4 you need to disclose credit notes, debit notes and amendments separately. Or the next activity which is required here is in credit note, please do not include your financial credit notes, that is those credit notes without the tax element. And other than this, we have Table 4G1 where you can get the details from Table 15. You can also cross-check in Table 311I of the GSTR 3B for to cross-check. Because this is a new table, I am mentioning the source of information. All the others more or less you will get from your GSTR 1 consolidated summary and the detailed invoice level details. You will get all these information from there. Additional liability, as I discussed, first time is allowed in this table. Can I reduce my liability in this table? Answer is yes. But will you get back the money if you reduce the liability? Answer is no. So what I mean to say is, if you had disclosed incorrectly in GST returns, it was not rectified at any point in time till today. That means till the October returns were filed. And in this nature, you have still realized you have paid excess taxes. Disclose the correct value in the returns, then you will show that the GSTR 9, Table 9 will disclose 3B paid is higher than tax paid. So to this extent, you have a proof, a document which you have filed showing that there is a excess tax paid. Refund application can also be made. This can be used as a persuasive evidence. Table 5 is the outward supplies without taxes, and this table, other than Table 5A and B relating to exports and SCM transactions, there we need to ensure our client has the LUT. Many times we are seeing client forgets to file LUT because it's an online process. Later on, department comes and says you have not filed LUT, all your without payment of tax transactions, I will charge the tax. The demand is very high, then getting the combination for not raising the LUT is a difficult process. So simple check, we can check if LUT is raised in the portal. Next we have table 5C, D, E and F. These are transactions where we need to consider for the purpose of ITC reversal. I know we are in the outward table, but this has a direct impact on ITC reversal. So 5C is in relation to transactions where supplier is raising the transaction and recipient has to pay under reverse charge. 5C1 is in relation to e-commerce transaction. This is not covered by the ITC reversal concept, please note. 5D and 5E, exempt and nil rated transactions. 5F, which includes non-GST supply. Non-GST supply in the format itself they have said includes no supply, which means they intend that you disclose schedule 3 items in table 5F. And to this extent, all these 4 databases, that is 5C, D, E and F, have to be considered for the purpose of ITC reversal. ITC reversal under Rule 42-43, Rule 42 for input services, Rule 43 for capital goods. Both the formats are different. Very common practice for clients to use Rule 42 computation for even the capital goods under 43. Those clients who have a varying exempt percentage or exempt ratio will face a possible demand with respect to Rule 43 miscomputation. Non-GST supply, of course, it includes Schedule 3 items. Not all Schedule 3 items are considered as exempt supply for the purpose of calculation. So, Section 17 has to be seen. There are certain exempt supplies themselves which have been kept out of the ambit for the purpose of ITC reversal. So, interest income and duty credit scripts, these are exempt supplies which have been kept outside the ambit for the purpose of ITC reversal. Certain Schedule 3 items also are included, like sale of land at the transactions with at the customs stations under 8A of our Schedule 3. Here, credit notes, debit notes amendments are not mandatory, these are optional. If you are having refunds with respect to the exports or SEZ transactions, Table 15 I know is optional, but many persons who are doing purely export and the zero rated transactions would like to disclose the details in Table 15 with respect to refunds. So when these are being disclosed, refunds for the year in the year have to be disclosed and not for the past periods. Any turnover not disclosed for the first time, you may be able to disclose here. Next we come to ITC reconciliations. ITC reconciliation, we have first 3 questions that we ask our clients. Have you taken ITC based on books only? Have you taken ITC based on 2B only? Or are you performing the matching concept before taking the credit? So this gives you a decision to make when you are filing your GSTR 9. If ITC is based on books only, the question which arises is, are you now required to do the matching on behalf of the client? Many of our fees, we charge double our fees when they are in the first position, because this itself is a monumental task. In the second situation, which is ITC claimed based on GSTR 2B only, they may not receive any notices initially, but they will surely be claiming excess credit because there would be credits not related to them at all. There could be ineligible credits. And I have not till date seen a 100% clean GSTR 2B where all the values are matching to the pie. There will be some value variances, corrections which the vendors would have to take care of. So even the second issue would throw out a lot of difficulty for matching. Third situation, which is ITC which is matched and then only claimed based on the GSTR 2B. This is the appropriate process. But here again, what is the process of maintaining the information must be understood. Whether invoice level details are available of eligible ITC claim for this financial year, permanent ITC which has been reversed in this financial year, temporary ITC reversal, and the ITC of GSTR 2B which is not relevant to the customer. This whether we have shown it in the table 4B1 as a permanent reversal on the behest of our departmental officers. We are seeing lot of notices being raised. Department is saying the total of 2B is 100, your total in 3B for the period is 80. Time period already has passed to claim the credit. So that 20 now please claim it and put it in 4B1, I'll get my revenue. This is a very common request, or request is a nice way of saying it, but very common request of the departmental officers. We have got many calls on 20th November for our clients telling please include these transactions in your GSTR. So how is the database maintained gives us an idea of what is the work which is entailed in making these disclosures on behalf of our client. The reason we take this ITC disclosure this seriously is because the last table, which is a verification table for the client, it requires a true and correct depiction of the database. So this true and correct is what the taxpayer is going to sign off saying that I have verified everything and it is true and correct, which means as a chartered accountant, I am no more under true and fair. Maybe you are doing stat audit under true and fair, but 9C is asking true and correct, which means arithmetical accuracy is required in the GSTR 999C filing. There is no materiality limit which arises in 999C. Materiality limit can arise for the client. They may say, okay, I accept this 5,000, you leave it. Get a mail confirmation from me. So this is very important to have all the documentation in this paper. So coming to ITC disclosures, we have table 6 where we have table 6B having eligible ITC, having the bifurcations of input services, capital goods and inputs. Inputs and capital goods are mandatory to be disclosed. Input services optional, can be clubbed along with the inputs. We have RCM from registered persons, RCM from unregistered persons and import of goods. So these details you can get from your GSTR 3B fairly easily, and the database here is what do I disclose in GSTR 6. This is the biggest question which arises. I will come to it in the next slide. In table 6F, your import of services, ISD, ITC which is reclaimed based on certain provisions, and Tran 1 trying to credit, now more or less a redundant topic, and ITC which is again in other cases. So these other cases is something that we use as a very useful tool by filing GSTR 9C. So how we are using this, again there is a separate slide for this. In the database now, import of services, there was a recent circular which came out which clarified that if you have not paid taxes for the past where the supplier was unregistered, you can raise the self-invoice now, pay the taxes, claim the credit in the present returns. The time limit to claim the credit is linked to the self-invoice date and not the vendor invoice date. This was the circular 211, if I am not wrong, which came out. Very soon, immediately, they came out with Rule 47A. This is now active from 1st November 2024, where they have said that the time limit to raise self-invoice is now 30 days. So basically now they have overcome the circular. Circular is now still applicable for the past. But any expenses beyond 1st November, you may need to follow Rule 47A. And if you have not raised the self-invoice, paid the taxes, in these situations there could be a possibility that you will not be able to fall back on Circular 211. So in say 20, 26, 27, when you have realized I have missed the liability of 23, 24, 24, 25, at that moment you cannot say that I am going to use this circular. They will say Rule 47A was there, your invoice date was supposed to be 30 days from the expense date, and to this extent your credit is disallowed. Liability they will still take from you with interest, but they will disallow the credit. So this means in relation to URD transactions, we need to have a robust mechanism in place. First and foremost, is it a domestic unregistered transaction? If answer is yes, have the list of RCM transactions liable. Are you liable for the RCM in that regard? Many clients follow a process on onboarding. When I am onboarding itself, I identify nature of transaction and I categorize whether this is RCM, FCM or what is the rate which is applicable. Import of services with respect to foreign transactions where you are paying forex. In this situation, see whether there is a requirement to pay the taxes. Reimbursements, very commonly missed out area. Employee reimbursements, there may be a RCM liability arising through these reimbursements. Have a look at those reimbursements also. Coming to practical disclosure in GSTR 9. How should I bifurcate ITC data for GSTR 9 disclosure? I have given it in a simple manner. ITC of financial year 23-24. When I say of 23-24, I mean in the books of 23-24, which is claimed in the same financial year of 23-24. In this situation, it is also reflecting in 2B of 23-24. I will disclose directly in table 6B. This is eligible credit. Next, ITC of financial year 22-23, books of 22-23, claimed in returns of 23-24, arising in the GSTR 2B of 23-24. In this situation also it will form part of my 6B. In my previous year, which is GSTR 9 of 22-23, this entry would have been disclosed only in table 13. It would not show in table 8C because 8C is when it was in the 2B of my previous financial year. So next situation, ITC of 22-23 claimed in 3B of 23-24, but it is in the 2B of 22-23. This is the most common issue or question which is raised. What do we do when the 2B disclosure is last year but credit is claimed this year? So in these situations, if I keep the data in 6B, I will face a variance while filing my table 8. Table 8 is taking as per 2B of the current financial year 23-24. That means this entry will not display in the 2B values, but it will form part of my 3B values during the reconciliation. Automatically, what it intimates to the department, 3B is claimed more than 2B. Then questions may arise based on this. What can we do to adjust this? We have two options. We can show it in table 6M or we can adjust it in table 8C. Alternatively, you can maintain the difference and make this explanation when they come for the departmental audit. There is also one more option. Along with your 9C, you can make this table and the difference which forms as part of table 8D, that can be under the like a management letter having the breakup of table 8D. What is the difference? What are the reasons why there is a negative difference arising in table 8D? So with this, you will be able to cover your position and also follow the format to the literal sense. If you don't want to take that risk of showing a variance in table 8D, the option which arises is showing it in table 6B, 6M or doing it in 8C. So if you see option 1, I have disclosed total value 5000 in 6A, which is auto populated. 6B also has the same value. In table 8A, you get only 3000 because the transaction of the in GSTR 2B of 22-23 will not reflect again in 23-24. Similar situation happens now for the temporary ITC which is reversed. So we have seen from July 2022 onwards, they introduced, August onwards this came into effect, where we had to disclose permanent and temporary ITC while filing GSTR 3. So there were many situations where credit would have been disclosed 2 times as part of table 4A5, but in GSTR 2B it would have come only once. This database now cannot differentiate the credit which has been claimed twice. So in table 6A, you will get the entire value, and again in table 6B, if I put the entire value, I will again face the issue while doing the reconciliation in table 8. So in these two situations, which is 2B of the previous year and the temporary reversals which has been disclosed, we will face this disclosure difficulty in GSTR 9, table 8. So to avoid this, we have two options. put it in table 6M. So you put the actual eligible ITC which is matched to GSTR 2B in 6B. Balance which is in relation to this 22, 23 and those which are claimed 2 times in the 3B because of the disclosure requirement, put that data in table 6M. Once you have this bifurcation, in your table 8, your 2B and your 3B matching will be correct. The data which will show there will be accurate and the disclosure of the difference which will arise in table 8 will be appropriate. Alternatively, there is an option to use 8C as the balancing figure. So whatever value is there, we reduce it in 8C because department also is raising a notice for table 6J. If you show a difference in table 6J, that is provided option 2, department is asking why you are having this difference. It is not correct and they are demanding the liability on that. So to this extent, reasons can be provided, but if you are conservative, option 1 or option 2 also can be taken. If you are disclosing difference in table 8D, suggest you to file a management letter along with the GSTR 9C. Next we have inward ITC reversals. Here we have rule 37 which is in relation to 180 days. We have 39, 42 and 43. Section 17.5 relates to block credits. 39 is your ISD related reversals. All these data we should ideally have an internal tracker of the same. If not available, then this has to be maintained. The reason is if we are not able to prove after 3 years to the department what I have reversed and against what values the ITC reversals have taken place, there is a very good chance I will be again paying the taxes on ITC reversal after 3 or 4 years. Like I mentioned earlier, table 5 CDEF, the linking with this table 7C and 7D is important. Please keep in mind, if you disclose there, ensure you disclose here. If you disclose here, ensure you disclose there. Any mismatch between these can lead to some incorrect disclosures. How many are following rule 37A presently? Rule 37A requires that I need to match and ensure that my vendor has filed his GSTR 3B. Till now we were checking GSTR 1 coming to my 2B. This matching now is more or less fixed. Now they have introduced next dragon into the picture, which is matching with GSTR 3B. So now the requirement is I need to ensure that taxes are paid to the government. This is there as per 16(2)(c) of the law. They have brought in rule 37A, which says that I need to ensure my vendor is filing his GSTR 3B. So anyone here matching GSTR 3B also for credit claim? So this rule 37A came in December 2022. Whether it is a mechanism which has been provided by the department, in my view, no. Whether it is possible to check, in my view, yes. There is GSTR 2A still in the portal. GSTR 2A provides an option of whether GSTR 3B is filed, yes or no. Now they expect us to match whether vendor has filed his 3B based on that form. GSTR 2B for the rule 37 and the matching concept which is there. Whether it is right on behalf of the department in asking us to do this, answer is no. Whether law is fair, answer is no. So keeping all of these things in mind, if we have to ensure our client's best interest, rule 37A has to be satisfied. There is a legal maxim which says that that which is impossible cannot be expected by the taxpayer. In this situation, providing proof that it is impossible is not possible. Because GSTR 2A is there, the details are available in that sheet, and simple VLOOKUP will give you these details. Should I do it on a monthly basis? You can do it if you want. Should I do it at least quarterly, half yearly? Better option instead of getting into monthly difficulty. So those persons who are linking vendor filing of GSTR 1 and 3B to their payment terms, which means unless you file 1933, I will not pay the tax portion to you. Will have to ensure this compliance without fail. Those persons who are not linking the payment terms to the return filing, they can do that on a half-yearly or even a yearly basis. But if this is done, say, on every April of the period for that entire financial year, you will be at least able to match and ensure you have the time to follow up with your vendors and ensure they are filing their GSTR. So common question is, how do I know whether my invoice has been paid in his GSTR? Common question. The answer is automated notices. So DRC01B has been implemented, DRC01C has been implemented. Wherever GSTR1 is higher than GSTR3B, by any taxpayer, be it your supplier or yourself, if your 1 is higher than your GSTR3B, you will get an automated notice that this is the difference, pay or provide the reasons why there is a difference. So this similarly will also go to your vendor if he is showing a higher liability but not actually paying it. Next is DRC01C, where you are claiming credit in 3B more than GSTR2B. Recently, one of our clients claimed the credit based on a manual bill of entry. So, in this regard, it did not come in ICE gate, therefore it did not come in GSTR2B. The notice was raised in the system. So, we had to provide the documentation and the reply, and we also additionally said that import of goods, if you see in this table, table 6E, here import of goods matching concept is actually not required. Section 16(2)AA uses the words invoice and debit note for the purpose of matching. Rule 36 provides documents for input to credit, which separately classifies input, debit, invoices, debit notes and bill of entry. So to this extent, law itself is giving you the benefit that you don't need to do matching. Second, section 16(4) time limit, that also says invoice and debit note. They are not providing then the time limit for bill of entry. So to this extent, if you are having import of goods or past periods not claimed, in my view, eligible. Very common concept, holding company outside India, subsidiary within India. Holding company arranges all the taxes and the documentation for the movement of goods. These are called DDP shipments, delivered duty paid. In these cases, importer name is the subsidiary in India. He is eligible to the full credit even though 1 rupee has not gone out of his bank statement, because tax has gone to the customs authorities under his name. So these are also eligible credits which are generally overlooked and missed out because there is no entry in the books of accounts. So when we do your stock versus your expenses, that time this can be identified. So table 8 has this reconciliation which we just discussed, 8A, B, C, D. If you see table 8D, 8D has the variance between table GSTR 2B and 3B which has been claimed as per table 6B above. So keeping this variance in mind, if your table 8D is negative, it's a cause of concern. If 8D is negative, it means your 3B is higher than 2B. And this could lead to questions from the department. Yes.
So 8A has values from 2A, no, not 2B.
So this financial year onwards, 23-24 onwards, it is going to be as per 2B. And this is the reason why, in my personal view, table 8 has more relevance from this financial year onwards. Now it is in line with the law. Law requires 2B matching.
Yeah.
9 also has 2B data. So once this database is now both synchronized, department can raise questions based on this table. So having invoice level details, again, very vital. At least in the past, if I am not wrong, 50% of taxpayers were filing this table based on overall reconciliation. If you ask invoice level, there is no invoice level details available. So having this database on invoice level is vital. 8D negative is a cause of concern. 8D positive, it indicates that you have either not claimed or it is ineligible. So that means time period has lapsed, therefore you have not claimed the credit, vendor has not filed whatever issues you had. It is not claimed within the November timeline. and the credit is not eligible, which is block credit under section 75. For that 8E and 8F is provided. So when 8D is positive, 8E and 8F must match table 8D. Import of goods, best way is to match whatever you have claimed to match it also in these tables. Because of the reasons I mentioned earlier, credit is eligible with respect to bill of entry without the time limit. Disputable, please, this is my personal view. Department will dispute that the time limit is applicable, but I provided provision wise the reasons why we can dispute. Next we have table 9 of tax payable and tax paid. Tax payable is an editable field, whereas tax paid is not editable. First and foremost, if you have additional liability added in table 4, it will automatically sit here if you are filing the return online. If you are filing the return offline, do it manually. Second, if you are adding additional liability in table 7, that is ITC reversal, that has to be added manually in this tax payable column. What could be the different reasons for difference between tax payable and tax paid? Common question. First and foremost is of course the additional liability. Second is previous year liability disclosed in the 3B in the subsequent period. So this is a situation where financial year 22-23 transactions I disclosed in the returns of GSTR 1 and 3B of April to October 23. So 23-24 period. To this extent, in the last financial year, by filing GSTR 9, I have disclosed these transactions in table 10, and to that extent in my table GSTR 9C, the reconciliation is already completed for these transactions. So these were transactions of past years disclosed in the present financial year returns, and to that extent reconciliation already done in GSTR 9C of 22-23. Should I disclose these transactions again in GSTR 9 of 23-24? Answer is no. I don't need to disclose these transactions again because it's already disclosed. So to this extent, you will have a tax payable versus tax paid difference because tax paid is not editable. Should I now match tax payable? You don't need to do this. Let the variance be. That's why I mentioned earlier in the first slide, management report, reasons for variance very important. Need not match items to nil. So have the reason for variance that this is a previous year liability. Next situation is excess liability paid in the current year adjusted in the next year. So to this extent, again, if you are disclosing the correct values, again paid will have a higher value, payable will have a lower value, but this would have a compensating variance in the next year. So to this extent, please keep in mind these adjustments which are being made. Understand the disclosure. I will come to again the spillover transaction separately. Tax payable editable. There is one more concept which arises in this table 9, which is negative ITC in GSTR 3B. In GSTR 3B, there is a possibility that total claim for the month says 100, but total reversal for the month is 150. So that means my net ITC for the month is negative 50, and that 50 has to be paid. That amount will reflect under paid through cash or paid through ITC in this table, and to that extent there will be a variance. So please have a look at those values also if your reconciliations are not matching. It could be because of negative ITC disclosure in the GSTR 3. Using ITC through DRC 03, we discussed it at the starting. This slide has the section and the provision references to back up the same. Next we have table 10 to 14, which has the details of transactions of financial year 23-24 disclosed in April to October 24. So three simple questions that we have to ask ourselves: whether it is booked in the current financial year 23-24, answer should be yes. Whether considered in the current financial year 23-24 GSTR 3B, answer should be no. And whether it is considered in the next financial year GSTR 3B, answer should be yes. If these simple basic questions are answered, then probably it is to be disclosed in this table of spillover transactions. Next, I have written consider positive values only in table 14. But just yesterday when I was going through one reconciliation, I saw that the portal is now allowing negative values also in table 14. So you can disclose table 14 negative values, which means you have to show the details based on table 10 and 11 only. This is only differential tax disclosure which has to be made in table 14. Next we have table 8C versus table 13. So if you see table 8C, it is ITC on inward supplies other than imports and RCM related inward supplies for the financial year declared in the returns of the next financial year based on the specific time period. In table 13, it is ITC await for the previous financial year which is declared in the returns of the next financial year in the specified period. Both the wordings are same, the only difference being in table 8 you should not disclose imports and RCM related ITC, but that can be disclosed in table 13. Secondly, and more importantly, table 8C is to match GSTR 2B. So again, let us take a situation where you have accounted an invoice in 23-24. The 2B disclosure is of 24-25. It has not come in your 2B. Let me take my own example which I gave in relation to the manual bill of entry. I claim the credit in my 2B based on manual bill of entry in 23-24. But it has not come into my 2B at all. In that situation, I will not anyway disclose because it is imports. There could be a situation where you have claimed credit based on the invoice, not based on 2B matching. And such credit, assume you have claimed it 24-25 and it has come in the 2B of 24-25. So both claim and 2B reflection are 24-25. You need not disclose it in 8C of 23-24. But should you disclose in 8C in table 13 of this GSTR 9? Answer is yes, because it is a credit of 23-24 in the books of accounts. All these complications set aside, table 12 and 13 are optional for this financial year. Should you disclose mandatorily? Answer is no. Again, I'll just finish. So table 13 is not mandatory, table 12 also is not mandatory. But if we go back to our discussion of having these invoice level details, having all the bifurcations, we will be very much aware when the credit was claimed, where the credit is reflecting and how the credit has been shown in the GSTR 3B. If we are able to match and have these details already in my internal working, what is the harm in disclosing in the returns? So this is important. It is at the option of the client or even the consultant to disclose table 12 and 13. Table 12 and 13 also are linked to 9C table for credit claim. It is also linked to my last year disclosures, and I can keep a matching of what they disclosed last year, what they are disclosing this year. If I have not disclosed 12 and 13, automatically I will not get into maintaining a reconciliation for that set of data, which means ITC reconciliation is not available. It's a clear indication also to the department. So having these details, 10, 11 mandatory, 12, 13 optional, 10 and 11 to be disclosed as part of table 14. Table 8C need not match to table 13, but in most of the cases it does, because these spillover cases generally are rare. So other than this, I think invoice level matching is mandatory if you are disclosing 12 and 13. With this, we will take a small break and we will continue. Thank you. Okay. So we also need to cover GSTR 9C. So I will restart the session. So keeping in mind outward supply disclosures with respect to spillover transactions, we have certain scenarios. So I would require your active participation. So first and foremost situation, outward supply of financial year 22-23 disclosed in GSTR 3B of 23-24, where it is shown in GSTR 9 of 22-23 in table 10 or 11. So assume it could be invoice, it will be table 10, RCM liability table 10, credit note, reduction of liability table 11. So in these situations, assume outward supply of 22-23 disclosed in 23-24 returns, and in GSTR 9 it is shown in the table 10 or 11. Should we disclose in GSTR 9 of financial year 23-24? It is coming in my GSTR 193B of 23-24, but it is forming part of my books and disclosures of 22-23 GSTR 9. Should I disclose in 23-24 GSTR 9?
In which table? Table 4?
In table 4.
No.
Yes. So answer is no, we should not disclose it. Already disclosed, already reconciled with even the GSTR 9C as per financial statements. So that is the answer. What happens? What is the impact of this disclosure? There will be a variance in table 9. So table 9 in the financial year 23-24, you will have a tax payable portion which will have a lower value. Tax paid will have a higher value because you have paid it in this GSTR 3B of 23-24. Please maintain reason. There is no requirement to adjust in table 9. Next question is credit note which is raised.
For tax paid more, department will never raise a question.
Yes, that is true. Even GSTR 9 has been formulated where if you are paying more taxes, please pay. You want to pay more taxes, we will enable in all ways and means. If you want to claim more credit, you want to take refund, not through this provision. Do it through some other way. So very clearly that has been their motto from the get-go. GSTR 3B also disclosure which they changed, which is creating a lot of difficulty for taxpayers, which means chartered accountants, because taxpayers are not doing it, they are doing this reconciliation. Biggest difficulty is in this ITC matching, having this reconciliation. The disconnect is because we can't speak to their vendors. If we speak to the vendor, say I have a call with his vendor, and the vendor and me have a fight, it creates a business difficulty for my client. So which means me doing vendor relationship management for my customer should now become a new stream of practice rather than tax compliance. So these are the things which the department actually is pushing us towards. Who is going to do this activity? If you give this to an MBA person, he does not know the law, he does not know what to do and what to check. So it requires a person who understands this, who understands the client's difficulty, and who can speak to the vendors. So in this situation, communication skills of our team members is also being tested to a very large extent. So next situation, we come to credit note which is raised of 22-23, disclosed in the GST returns of 23-24, were shown in the GSTR 9 of 22-23 table 4. So physically credit note was raised in 22-23 financial year, but it was disclosed in the returns, GST returns, GSTR 193B of 23-24. And in GSTR 9, the wordings used in table 4I say that credit notes in relation to those specified above. So that's why they included it in that table, because the original invoice was in 22-23 and credit note also was actually raised in 22-23, only disclosure happened in the next year. So GSTR 9 of 22-23 carried this credit note. In the GSTR 9C of the financial year 22-23, this credit note also would have reflected in the turnover. which means once I include it as part of my table 4 in 9, GSTR 9 of 22-23, my 9 and 9C are matching. What happens to my disclosures here? So what should we do in financial year 23-24? Should we again disclose the credit note? Answer is no. We should not disclose these credit notes again, even though it is forming part of my GSTR 1 and 3B. What is the impact of this transaction? Your table 9 of GSTR 9 of 22-23, because it did not form part of the returns of 22-23, but you have included it with the GSTR 9, your tax payable will reduce to that extent, tax paid will be higher. In the next year, your tax payable will be higher, your tax paid will be lower. This is an example of compensating variance. The first one is a non-compensating in nature, second one is compensating in nature. Both of them are transactions disclosed in the returns of 23-24, but we need to be careful in weeding them out before we disclose data in GSTR 9 table 4. Next we have liability which is disclosed in GSTR 9 of 22-23 but paid through the DRC 03 in this financial year. Very common, 22-23 GSTR 9 is to be filed, the annual returns is to be filed in the financial year of 23-24. So say I raise my DRC 03 by filing the 22-23 GSTR 9. So to this extent, should I again disclose in my GSTR 9 of 23-24 any transactions with this liability? Answer is no, not at all required, because already disclosed, already paid. Here in the table 9 of GSTR 9 of 22-23, your tax payable will be higher. Naturally, it will be higher because you added additional liability. Tax payable is higher than tax paid. The differential amount you should be able to substantiate basis of DRC 03 form. And will this have a compensating variance in the next year? Answer is no. So all three types of transactions where there could be compensating variance, where there would not be compensating variance, have been discussed. So then we come into our optional tables. I will go through them a little quicker. We will discuss more on 9C. Table 15 and 16 are optional. Refund details, demand details, job work details. Job work, if anyone is performing these transactions, please keep in mind all the job work register availability. Whether goods have been returned within the time periods which are prescribed. If not, there is a tax liability which is there. Do not forget to suggest that the client needs to pay these tax liabilities. Just because this table is optional does not mean the tax is optional. Tax is mandatory. That has to be paid. Only disclosure they are suggesting that it need not be disclosed over here. Table 17 and 18. Table 17 relates to HSN outward, 18 HSN inward. 18 is optional, 17 is mandatory. So like I mentioned, match your table 5N plus 10 minus 11, which should exclude, I have written including advances. Please excuse that mistake. It should be excluding advances. The table 17 should be disclosed. Schedule 3 items also must not be disclosed here. The portal, when you are filing this table, it requires that your tax value into tax rate should give the taxes which should match to the decimal point. So if you are consolidating GSTR 1 of multiple months and you are uploading it directly, but there is a variance, the rate if you calculate is coming 17.98 instead of 80%. The system will not allow you to file the HSN table. You need to match to the decimal point. Why is this required? Absolutely no idea. It is a redundant issue. We don't deal with paisas anymore. But department still has this kind of issues for us. Earlier tax rate was not part of GSTR 1. Now it is forming part of GSTR 1, which makes our jobs a little easier in consolidating and filing these details. Late fees for delay in filing GSTR 9. Earlier, there was a question whether the late fees given for annual returns is also similarly applicable for delay in filing the reconciliation statement, that is a GSTR 9C. Answer is no, it cannot be made similarly applicable. So, Anisha Chandrakant Kerala High Court decision provides clarity on this aspect. Late fees applicable for annual returns, general penalty applicable for 9C. So, this position can be understood. Late fees given within the form in table 9 is for delay in filing GSTR 1 and 3B. If you have delayed filing GSTR 1, does the system auto-populate late fees? No, right? Is it payable? Yes. So generally we see people are not paying the late fees for GSTR 1. And then later again there is a question which is raised. So 3B of course it is automated, so you do not need to worry. But GSTR 1 late fees, just verify whether it is all filed on time. Nowadays very few delays are seen because customer credits are late. So GSTR 9 departmental issues. First and foremost, they are disputing on outward supply which does not match with GSTR 1 or 3B liability which has been disclosed. There could be various reasons. Just now we discussed spillover transactions, transactions of past year which is reflecting in this returns, but we have excluded because it need not form part of my returns for this financial year. There could be reasons for variance. There is no need to panic because they have raised the notice. We need to understand and match with the returns. So therefore, like I mentioned in the starting management report, if I open my reconciliation statement, turnover, outward supplies with tax, I will be able to match it with my 1 and 3B. If there is a variance, there could be a variance with GSTR 9. That reason, which could be because of previous year disclosures, that would be provided in my notes. So that I will then be providing as a reason to the department and clarify and close the dispute which is being raised. Very common issue, advances which are disclosed in GSTR 1 is not matching with GSTR 9. So GSTR 9 requires that your table 4F advances is net advances for the financial year. How we are computing that? We are taking total advances for the year which are paid, total advances adjusted for the year. Net value, whether it's positive or negative, we can put it in 4F. 4F accepts negative values also. So to this extent, there could be a situation where the understanding was incorrect. They disclosed only advances that were received during the year, even though invoices were raised, leading to a mismatch in the data between GSTR 9 and GSTR 1. So please keep in mind how the disclosure has been made in GSTR 9 for the purpose of responding to the department. ITC mismatch disclosed in table 6J. This is when you use table 6M as the balancing figure for those temporary ITC reversals and the 22-23 related transactions which were claimed in 23-24. So when you do use 6M, automatically 6J comes as a variance, but table 6O will always be matching to the total of table 6A, which is my ITC which has been auto-populated based on GSTR 3B. So to this extent, we have to again maintain reasons for variance and provide the same to the department. Table 9, payable versus paid mismatch, like we have been discussing till now, no need to make any adjustments. Please have the reasons. If you have paid DRC 03, have the DRC 03 document on hand. Table 18 negative, we have discussed. HSN not matching to table outward supply of 5N plus 10 minus 11 could be advances and the schedule 3 items. So now we come to GSTR 9C. This format fairly simple. Turnover reconciliation first, tax reconciliation next, ITC reconciliation last. All the other tables, this additional liability, the table 14 of ITC having all those expense-wise details are optional. Most of the persons are doing the additional liability in GSTR 9 itself. I have not seen many additional liabilities coming into our form GSTR 9C. So, what are the changes in this form. There are no changes as such in this format. Table 12B and 12C were mandatory earlier, it remains mandatory. This is with respect to ITC disclosure, ITC of past year claimed in this year and ITC of this year which are claimed in the next year, that is 12B and 12C. Table 5, all the tables other than the first, which is your table 5B, is mandatory. Very common mistake being done across is till date all the turnover adjustments are shown in table 5. The other tables are not being used for disclosure, but those tables were mandatory for the last 2 years. It remains mandatory now also. We will come to each of what those disclosures could entail. Table 14 remains optional, but in your form 3CD clause 44, it does require you to disclose these details. So if they do bring in this table 14 as mandatory, we do have a database for the information. Whether it is matching, we will come to that later, but we have some level of information readily available. So you can't see this table, I've just put the table reference. So we come to each and every table, what it means. So table 5A, this is coming from your financial statements. If you have multiple GST numbers, please ensure it matches on an overall basis. If you are following different period in your Companies Act, but IT audit report is having the financial year disclosures, please consider the IT audit report instead of the company law report. 5B, this remains optional. It is in relation to the unbilled revenue. So I will be speaking only of the mandatory tables. So now whatever we discussed, all these tables are mandatory. Only 5B was optional. 5C to 5N is mandatory. 5O is the adjusting table which most of us are using. So automatically that is mandatory for us. 5C is unadjusted advances at the end of the year where the invoice is not raised. This is a transaction which has to be added because it will not form part of the 5A revenue. 5D, deemed supplies, which is in relation to stock transfer and cross charge. So goods and services, if there are invoices being raised within the PAN to various GST numbers, that comes under this deemed supply concept and should be added. If it is already forming part of financials, sometimes errors are made, it is not removed from the financials. In that situation, don't add. Please verify whether it is forming part of financial or not before you add them. What is our verification? In relation to stock transfer, there could be the e-invoice verification, e-way bill verification, which could be done. Recently, Circular 199/2023 was released with respect to cross charge. You can refer that whether cross charge is applicable or not also can be understood. That is a beneficial circular which also says that the invoice need not be raised where the credit is fully eligible. Please keep in mind, once ISD provisions are implemented, which is from 1st April 2025, it is already notified. So 1st April 2025, ISD is becoming mandatory. Circular 199 is no more valid in respect of ISD related transactions. Internally generated services still form part of the circular and the circular continues. But in relation to third party invoices with respect to services, ISD provisions are mandatory from 1st April 2025. Table 5E, credit notes issued after 31st March of the current financial year but taken in the annual return, which must be reduced. So like I mentioned in the earlier situation, if there is a credit note issued after, so it is financial year 24-25 credit note, but it is taken in the annual returns of the 23-24. At that time, you would have to adjust in this table 5E. If this is not done, which ideally it should not be done in this manner because it adds another reconciliation method. If it is done, then it needs to be disclosed here. Table 5F, trade discounts accounted in financials but not allowed in GST to be added. How do we understand that it is not allowed in GST? We need to see section 15.3. Credit notes are under section 34. The conditions for these post-supply discounts are under section 15.3. Table 5G not relevant, it's for the past period. They should have deleted this. Very easy to delete, but this shows the lethargy in them. Wherever the tax is not coming into their kitty, they are not bothered about the format. 5H, unbilled revenue at the end of the financial year to be deducted. This is something where it is in line with the 5B, unbilled revenue opening, unbilled revenue closing. So which means if you had unbilled revenue closing last year, please check last year GSTR 9C, whether your opening is matching. Very easy check basis, which generally there sometimes is a variance because they are using these unbilled revenues as the balancing item areas. Similarly, even for the unadjusted advances at the beginning of the year and at the end of the year. Next, we have credit notes accounted in the financials but not allowed in GST to be added. That means turnover in the returns are not impacted, but turnover in the financials have been reduced because these are financial credit notes. They have to be added back for the matching concept. Supply of goods by SCZ to DTA. DTA has to file the bill of entry for home consumption. This will come in his GSTR 2B as an inward supply directly, and he has to pay the taxes. He as in DTA has to pay the taxes to the customs authorities. To this extent, SCZ does not pay anything to the government, and for that reason, this has to be deducted. Even though it forms part of turnover of the SCZ entity, deduct from here, DTA will disclose as his inward supplies. Turnover of composition scheme to be deducted. This is in case he shifted from composition to the regular scheme in between the financial year. Table 5M, adjustments on account of section 15. Section 15 is in relation to valuation provisions of GST law. And here, if there is a variance between valuation as per GST and valuation which you have considered for the purpose of your accounting, there could be variances in between these two. The difference of those values must be considered in this table 5M for the purpose of matching. Some examples are given. Value with respect to the notification 8/2018 sale of used or old motor vehicles, where they are asking you to do it on a margin basis. Same for second-hand goods. The dealers who are selling the second-hand goods also covered under Rule 32(5). They also would need to consider these valuations as an adjustment value. Here, normally 5O is being used for the disclosure. Suggest to use it in table 5M. Pure agent expenses, as per Rule 33, if you are able to satisfy all the 7 conditions of pure agency, you need not bring that portion into tax, and it can be kept outside the purview of taxation. But in the books of accounts, sometimes it will be added as part of the turnover, it is not part of the balance sheet. So to that extent, you may need to adjust in the GSTR 9. Transactions with related parties, you may have transacted at ₹1, but open market value is ₹10. Tax will be paid on ₹10, but the difference in the turnover has to be adjusted in this table. GST on construction paid on total value in financials, it is fully accounted. This valuation variance also needs to be accounted for here. Forex related fluctuations are coming under table 5N, so gain or loss, add or deduct. Last one will come is table 5O. In table 5O we have turnover which is not covered in any of the above. So only if you have turnover adjustments which does not cover between 5C to 5N, please disclose here. If it is in 5C to 5N, it is our duty to disclose in those respective tables. Just because I disclosed in 5O, department can raise an issue with me. There is no variance in value, there is no tax variance, but still we are giving an option for the department to raise queries. What are the examples which could come under table 5O? We have index adjustments which could arise. We have duty drawback, the scrips, dividend, interest income which forms part of the financials but not liable to GST. All of them can be forming part of this table 5O. So then the last table, which is 5Q, turnover may be derived from 5N plus 10 and 11. So once you file GSTR 9, the data which has to be used for filling GSTR 9C will then get auto-populated to one summary PDF, which has to be downloaded, and then you need to key in the values in the GSTR 9C and then upload. Again here, when you are keying in the data which you have downloaded, please make sure it matches to the decimal point. If it doesn't, again it throws an error. So in this table 7, we have discussed table 5, which is turnover reconciliation with GSTR 9. This takes the total turnover, outward supply with taxes and outward supply without taxes. Next table, which is reconciliation of turnover in table 7, is matching the outward supply with taxes only. Now they are not worried about those without taxes. They want to match the turnover with taxes. To this extent, you need to exclude these transactions with respect to exempt, nil-rated, non-GST, zero-rated supplies, where it is without payment of tax, and RCM-related transactions. Keep in mind, Table 7 has not been modified with respect to Section 9.5 e-commerce transactions. So this change in GSTR 9 that has come with respect to disclosure of tax payment with respect to e-commerce. Now, if I take an example of an e-commerce operator who is liable under 9.5, he would have shown liability in table 4G1 of GSTR 9. In his financial statements, this is not a income because he is the person facilitating this transaction. It is the turnover of the supplier. So to this extent, whatever I am making out of the transaction forms part of my income in my financial statements. And to this extent, I will not be able to adjust that value here. I will not be able to reduce that value from these values, and my taxable turnover will show a higher figure compared to what is there actually in my financials. This is one. But if you see the next table, which is table 9 of GSTR 9C, this has the rate-wise tax payable as per my books of accounts. It is my liability to pay as per Section 9.5. Therefore, even that e-commerce related transaction liability I will disclose in this table. From the purpose of matching table 7E, which is taxable turnover as per adjustments above, that is as per the books of accounts, if I match table 7E taxable turnover against taxable value which is auto-populating in table 9, I will be able to do an internal check on whether my books of accounts have been maintained correctly on a rate-wise basis. Reason being, here again, whatever taxes I disclose must match with the rate which is provided. So if it is at 18%, if my taxes say I have put as 180, my taxable value should be 1000. I cannot show a different taxable value. If I show say 1802, it will not allow me to file the return. Because here again decimal point verification is there. Which means my GSTR 9C has a provision to match turnover basis and rate wise liability. So in the beginning when we were discussing important reconciliation, I had given a separate line for rate wise liability. This is the reason for that. If I have rate wise liability as per books of accounts, I will be able to match. Why are we discussing this at length? Reason is, many times in the system, rates are being picked up incorrectly. If you see many cases, 15% is charged, 10% is charged, 22% is charged. None of these rates are in GST, but taxes are paid based on that. Department is not aware, even client is sometimes unaware of this because they think they are paying the taxes correctly. What are we doing in the returns? Sometimes returns, what are the value, we back calculate, we show that the turnover and we close the entry. What leads to variances when we file our 99C? There will be a variance in my turnover. In the hotel industry, very common, 18 and 12% there is a variance. Almost all hotels which I have done the work for have this variance. What is the reason? Because in the system it is raising for certain transactions 12%, it's calculating incorrectly at 18, sometimes calculating at 18 and then it's given at 12. What happens when we are doing this check? We realize that yes, there is a variance internally between the taxable turnover disclosed versus the taxes which have been back calculated to arrive at the turnover. So table 7E versus taxable value of GSTR 9C table 9 is another best practice that can be implemented. And 4G1 is not included here, maybe rightly so. Whether it is overlooked, I am not sure, but in my view, if it is not done also, we can substantiate the reason for this. Coming to conditions related to exemption need to be verified. Please confirm that the exemption still continues. There have been multiple notifications in the past 6 months. Sometimes that exemption itself may have been withdrawn, we are not aware. Sometimes the conditions for export of goods, export of services may not have been satisfied. Realization of foreign currency applies even for goods. Please ensure that these realizations also are verified and documented to avoid any disputes in the future. Even if you are not doing the refund for the client, please get these confirmations in place to avoid any disputes for them in the future. So, what are the reasons for variance in this table? So, we have tax payable which comes out of my books of accounts. As per GSTR 9, we get data which arises as taxes which are paid. These taxes which are paid, which arises in this table, is coming from my table 9 of GSTR 9, which has the tax payable versus tax paid. That detail is getting auto-populated into this table. Here we have interest, penalty, late fees. If you, I will just show the table. Yeah. So if you see here, interest, late fees, penalty, they are shown only as tax payable. There is no option to disclose under CGST, AGST, SGST. The data which goes from here into the table of GSTR 9C is IGST, CGST, SGST cess. So this means that the data which is coming from GSTR 9 does not include interest, late fees and penalty. But if you have accounted for this in the books of accounts and you are disclosing it here, this is an automatic reason for variance. Next one, in relation to RCM related liability, additional liability, and if there is ITC reversal related additional liability which you have considered in GSTR 9, that would again form part of the variance here. Because in this table it may not consider, because if you go back to this table, RCM is considered, ITC related additional liability you will not be able to disclose here, because it is reconciliation of tax paid and it says reconciliation of rate-wise liability. So rate-wise liability does not generally arise with respect to ITC reversal. So to this extent, ITC reversal additional liability would not form part of the GSTR 9C table 9, although forming part of my GSTR 9. So to that extent, reason for variance. Negative ITC, another reason for variance. If you have considered an adjustment while filing GSTR 9, then you would need to make subsequent adjustments even in the GSTR 9C. This is for those people who like to see name in the values, who do not want to give reasons for variance. This can be a reason for variance. Next we come to part 4, reconciliation of ITC. Here we have ITC which is arrayed as per AFS. Arrayed as per AFS, they are asking you to take only the debit side, other than those adjustments which are not in relation to actual credit claim. So these are in relation to those invoices against which credit is claimed. Here again in this table, there is no need to do a closing credit matching. But like I mentioned in the starting, important reconciliations, when we do credit matching, we are sure of the values that are being disclosed. We can say this was my opening balance, this was the purchases of the period, this was the amount that was utilized, and this is the closing balance. And when we are able to say this, that means I have the details of eligible ITC on an invoice level basis. And that gives me proof of disclosures done in GSTR 9. As a chartered accountant, then I will be able to satisfy all the checkpoints for my internal satisfaction that I have been able to match and verify everything. Otherwise, there has to be limitation which we are getting a management representation letter telling that these are the things which are my work limitations. If not, in the future again, we could be having some disputes with the client. So 12B and 12C, like we discussed, is mandatory. 12B is ITC which is booked in the earlier financial year, claimed in the current financial year. We need to match this with table 12C of last financial year. Between last year 22-23 to 23-24, in my view, we will see a major variance between these two tables. In the instances where 22-23 table 12 was filed based on overall reconciliation and not invoice level reconciliation, but this year you have done invoice level reconciliation based on GSTR 2B. You would face a variance because now that you have invoice level reconciliations available, the value will be different. So let us take a scenario. Last year you disclosed that table 12C was say 100 rupees. This time your table 12C, 12B of 23-24 is actually only 80. This indicates that ITC which you had considered earlier that it is eligible to be claimed in next year and you have actually claimed is incorrect, but you claimed only 80. So you disclosed 100 last year, but you claimed only 80. That's what you have shown now in this working. Even in your table 6M, if I go and verify also, it should ideally match to 80. The 22-23 credit claimed in 23-24. So 6M can be used as a matching figure for 12B of this year in relation to 12C of last year. So this is a three-way check, internal check that can be performed. But where this value 80 and 100, if it is switched, say last year you have put 80 but this year you are showing 100, this indicates that there was a error in your ITC calculation in the previous year. Last year you said that you will claim only 80 in the next year. This year you have told you have claimed 100. This could mean that you have claimed same invoice 2 times to the department. This indicates as such to the department there is a possibility that you have claimed same transaction twice in 2 financial years. So please keep in mind where 12B is higher than last year 12C, it is a cause of concern. Where 12B is lower than the last year 12C, not a cause for concern, but there could be some missed out ITC also. 12C, which is there presently, we can match it to table 13 of GSTR 9. So this interlinking between 9C and 9 also is available. Possible reasons for mismatch between table 12 and table, ITC as per books and ITC which is disclosed coming out of our GSTR 3B. First and foremost is lapsed ITC which is not reversed in the books of accounts. I have retained credit in books of accounts, not reversed it. In this situation, we show it as credit which is not claimed but remains in my books of accounts. Under protest ITC. Under protest ITC, first and foremost I give a disclaimer because we are all chartered accountants here. Under protest concept is not available in GST law. But in our view, it is a principle of natural justice. If you feel that you are eligible to the credit and you don't know whether you are eligible to it, what are the options available to you? Recently, section 11A has come out, which has said that excess or short taxes which are being paid based on industry practice can be regularized based on this section 11A. Similar provision is not brought for the ITC provisions. So, in this situation, if you go for under protest for outward supplies, I feel they can dispute based on section 11A because you have not made a recommendation. But in relation to ITC, under protest may still be valid. Many persons who have taken under protest for the safari retreats credit recently, some of our clients recently have claimed up to 14, 15, 20 crores of credit in the recent claim. So this is the benefit that can arise based on this under protest. Will department dispute 100%? Can we win the case? 100%. So in this situation, possible. ITC which is booked based on GSTR 2B incorrectly, like we were discussing, there could be situations like this. That could be a reason for mismatch too. Alternatively, additional ITC which is being reversed based on the GSTR 9, which is not considered in the books of accounts, that also could be coming into the reversal under this table. Reasons for mismatch. Table 14 is not mandatory, and your additional liability in GSTR 9C again we may not be using because it's in GSTR 9.
So we go back to that slide. Yeah, this one. So A 12A will be as per financials.
Yes.
So it will be suppose 100. And in my 2B, actual 90 has come. Okay. And so unreconciled, it will show, suppose last year and subsequent year, but I have claimed in March itself. So no subsequent year, I am not claiming in 2B of next year.
Okay.
So it will come in unreconciled.
Okay.
I have shown in 6M in 9. Then
So in your returns, you have shown 90 in 6B, 10 in 6N,
yeah.
100 you have shown, which is coming in table 7J is the total ITC as per the table 6 and 7.
Yeah.
So net ITC is 100,
Yes.
which is also as per your books of accounts.
Yes.
Correct? There is nothing which is claimed in the next year 3B.
Yes.
It may be reflecting in next year 2B,
Correct.
but not in the 3B claim.
Yes.
To that extent, 12A,
Yes.
100. 12B, 12C, nothing.
Yeah.
12D will come auto-populated from 7J of GSTR 9
Correct.
as 100.
Yes. And
So this will be variance 0, no mismatch.
Oh, okay. It will come as 100.
It will come as 100.
Okay.
If you have claimed ITC in relation to the 23-24 in the next financial year, that portion will form in table 13 in GSTR 9.
Yeah.
Same value you will also disclose in 12C.
Yeah.
So to that extent it will get reduced from my 12A, and again my reconciliation is on par.
Yeah.
So in relation to GSTR 9C, what are the areas of check? The reason we have provided these aspects we have given on supply, outward supply and procurements is because earlier in the starting when the certification was removed, it was a common understanding that GSTR 99C, which is performed by a chartered accountant, should only be done for the concept of arithmetical accuracy in mind. He need not verify any of the GST concepts with relation to the client. Based on this, the fee also was decided for the client, drastically reduced because I am just doing the arithmetical accuracy. I am not getting into verification of the transactions at all. So here, even though it is legally fine, as professionals we have been seeing that our name in the society has been gradually reducing. Now slowly they are trying to take out even our points. So keeping this in mind, now maybe it is our job to ensure that even though it is not part of our fee, we do these services. Because this activity will show the difference of a person who knows the law and a person who doesn't know the law. A person who doesn't know the law, and I'll be frank, it is a person maybe BCom, MBA, who has not done CA, who has not learned the law. Maybe there are persons of those categories who have learned, but I am taking the majority of the persons. They would not be able to verify these nuances of the tax laws. This is where our difference lies, and this is where we need to make our differences known to the client. So, keeping this in mind, what we must review it during our GSTR 990. If there are exempt supplies disclosed, whether exemptions apply, if there are concessions claimed, there is DSIR, research related 5% exemptions which are there. Merchant export 0.1% is there, there are conditions to be satisfied. Whether the conditions are satisfied. Deemed supply under your deemed export transactions, whether those conditions are being satisfied. There are specific restrictions with respect to refund with payment of tax in respect to those transactions. We need to ensure they are not being claimed. Reviewing of transactions with related parties. Recently, corporate guarantee was clarified, whether they are following the transaction with respect to those supplies, whether benefit of circular is being claimed. Are they unnecessarily paying taxes, accumulating credit in their branches where the transaction value can be deemed to be nil as per the circular. Nature of supply, mixed versus supply, mixed versus composite and non-composite. Recently, two instances we came across. One is extended warranty. So a dealer who is purchasing from the OEM and he is giving his own extended warranty on the product. In those situations, the general practice of a customer is to purchase the goods along with extended warranty based on the salesperson's push. At that moment, I need to charge tax based on the goods rate. The general industry practice is 18%. What would you buy extended warranty on? Would you buy it on cooker? Would you buy it on AC? AC rate. AC rate is 28%. Would you buy it on TV? TV is bigger than 32 centimeter or inches is 28%. So common mismatch in tax rate. Direct 10% liability is there on the dealers. Are they aware? Most of them know. Some of them aware, still following the industry practice. Whether they can go under section 11A, can they file a representation to the department? Answer is yes. Circular has come out telling that this is not deemed to be a composite supply when, it is deemed to be composite supply when sold together. So now can we ask the clients to raise separate invoice on a different day? Practically would be very difficult because I will receive payment on not the same day. So I am now not in substance over form, I am trying to do some kind of a illegal activity. So we need to keep our clients abreast with these changes. Second thing which is there is in relation to freight. Same composite supply clarification which came out. A person who is doing a freight transaction say from Karnataka to Tamil Nadu, at Tamil Nadu, the person who is receiving the goods, the consignee asks for some additional services. Generally, the booking entity, that is Karnataka, will raise the invoice. But he is not performing any freight activity. Say he is doing some hamali work, unloading, loading, or some kind of warehousing services. In these situations, he is not provided freight services. He has to do standalone service classification, and ideally that will then come under 18%. Now imagine a GTA who is generally not charging any taxes. All his transactions, recipient is bearing the burden of SCM. Suddenly, circular has come out telling that in these situations it could be paid. This is generally in the paid transactions, not the two paid transactions. It's in the paid transactions where consignee pays the freight portion upfront, where he will pay RCM, but consignee when he receives the goods may be taking some additional services. GST may be applicable under FCM in those situations. Big change for the industry, but again, whether it is clear for the industry how they must follow, what they must do, is not very certain. So classification, rate of tax, we need to understand there is a clear-cut process of how we must classify goods and services. That is based on the erstwhile also it was in the similar fashion, now also it's in the similar fashion. Please keep that in mind. Sale of fixed assets using motor vehicle, the values which are there in the returns, values which we consider are all different. There should be appropriate taxation. Very common misconception in the sale of fixed assets with respect to motor vehicle, it says WDV as per income tax to be taken. Income tax is based on block concept. Once the goods are sold, WDV for the goods ideally you can find only on 31st March of the previous year. So we can take WDV of that rate. What is being done in practice? We are computing that rate, we are taking till the sale date and then we are computing the WDV and then considering the margin and then it is being subjected to tax. This is increasing my margin for the tax payment. Ideally, we can take the WDV as on 31st March. We are still in line with the law.
So 31st March of which? 31st March?
So if I have sold it in say 23-24,
Yeah.
March 23.
We should take that WDV.
That WDV.
We should not charge, we should not
Compute in the date of sale. So if you read the provision, it says WDV as per income tax. Can you identify WDV as per income tax as on that same date? It's not possible.
And if it's a loss, then we may not do
Yes,
it.
if it is a loss, then there is no transaction value. Next issue is many people are taking that wherever there is a loss, they are taking that to be exempt supply. That also is incorrect. Next is time of supply concepts, commonly overlooked point, which is we are not identifying when the supply was supposed to be made, when the invoice was supposed to be raised, and the interest implications are being overlooked. If we are able to identify this for our clients, at least we get them ready to face the department when these issues are being raised. In relation to ITC, claim of ITC, fulfillment of conditions, like we just discussed, Rule 37A, majority is not verifying this, but provision is there in the law. Doubtful credits, what are we doing? Whether we are claiming, keeping it in temporary ITC, what position are we taking? Water ITC, for example, that is the Bisleri water bottle, that has a 12% rate on it. Is water a beverage? Answer is no. Credit is eligible. But it is being classified as a beverage and they are telling ITC is restricted. Department also sometimes has similar view, but there is a Supreme Court ruling on this. Goods which are of promotional in nature, especially when clients are doing it, say they are putting Accenture logo, they have a shirt, and that is given to them as part of the policy where it's written that all these items which are productive, bottle, flask, dairy, anything that they are giving. If I mention in my HR policy that these are being given as part of onboarding policy, upon exit you have to return them as these are properties of the company. What says that I cannot claim this credit? Similarly, if I give the same thing to my customers or my vendors who are doing business with me, why should I not say these are business expenses? Are they samples? Are they my outward supplies? If that is so, then yes, there could be a dispute. If you are giving your own goods as a freebie to people, then it comes either under section 17.5 or it goes under schedule 1 of clause 1. In either situation, you would have to have a reversal of that tax. But in relation to promotional goods, where is forming part of your expenses, that too indirect expenses, there is a good possibility of claiming that credit. Are we giving these kind of benefits to our clients? RCM liability. Generally what is happening, entire forex is being considered into 80% and RCM being paid, credit being claimed. Department will come and tell all these transactions not liable to RCM and you have claimed excess credit, reverse it. Tax you have paid, I'll keep it, thank you. So to this extent again I have to do refund activity, I have to pay interest on the ITC excess claim, it becomes a hassle. What we need to understand, whether place of supply is in India, whether the transaction is actually liable under reverse charge. So having understanding on these transactions very key. Year-end procurements, that is your goods in transit as on March. Based on targets, lot of billings will be taken place, but actual goods receipt is in the next month or after 2 months also. To this extent, you may have received the invoice or you may receive the invoice in the next period. But to be reflection coming in next periods, coming in the March month does not validate credit claim. Receipt of goods is very important. Similarly, receipt of service. Now, in the case of e-com bill, they mentioned that just showing invoice and showing some small proof is not sufficient. You need to show your proof of actual movement of goods. Give me lorry receipt, show me your GRN register. What is your process? They wanted to understand the entire details before saying yes, your credit is genuine. Just showing invoice and 2B is not sufficient anymore. Having additional these internal processes set up to prove the transaction actually took place also is vital. Classifications of goods as input or capital goods, job work related, very important. Capital goods also separate disclosure in GSTR 9 is required. In relation to refund, capital goods when you are going for the refunds, without payment of tax you cannot claim the capital goods credit, but with payment of tax you can claim the credit. This option, whether we are giving this benefit also to our clients. Wrong type of, yes.
RCM paid on residential rent given to employees, staff.
Okay.
Whether ITC benefit can be offered.
So, recently they have clarified, and even in the past there was some understanding that where the residential dwelling is being used for residence, RCM should not be paid. But later on it was clarified that if the RCM is for being used as residence, but it is being used by a person registered. Say I am a company, it is the rental agreement is in the name of the company, but it is being used for residence. In that situation, RCM is applicable.
ITC claim.
So yes, so first we are coming to liability. So here we are clear that liability is set. Now in case of a proprietor who is taking same thing for his residence, RCM is not applicable. In those situations, then ITC also there is no question that arises. Where is the question of ITC ineligibility in this transaction? It comes out of section 17(5) on personal consumption basis. So we need to first understand personal consumption. Personal consumption from whose eyes? Is it from the eyes of the employee? Is it from the eyes of the company? Or is it from the eyes of the department? Now in this situation, it should be seen from the eyes of the registered person, that is the company. Personal in that nature would be, say, I am the CEO of an entity and I have used my office funds to fly my family or give my daughter some education, and in this situation all those credits I have kept in my books of accounts. Those are all personal in nature. When an expense is in the books of accounts and it's a business expense, saying that this expense is personal in nature cannot be validated. You can always dispute it. So wherever they dispute that these are personal in nature, it can always be disputed. And generally department is using that as one of the reasons why they are disallowing the credit.
In that case, in that case, for a company or a private limited company or public limited company, there will not be case of public personal expenditures.
Ideally no. It should not be there.
So what I see is if the amount is debited to profit and loss account, you can claim the credit. If it is not debited to profit and loss account, you should not claim the credit.
Yes, sir. And as per your income tax act, it should be an allowable expense.
Yeah. So normally what we debit in profit and loss account is allowable expense.
Yes. So say someone has considered even disallowed expense as part of P&L.
So what will happen is in income tax statement, I'll say it's a personal expenses disallowed.
Yes.
So the check is there.
Check is there.
Yeah.
So we can make that check in the credit claim. So once it is clearly personal, then we should not claim. So many places what happens, directors' house related bills are all accounted in the company. His phone, his internet, his family's phone and internet and all those things are accounted. They buy AC and all for the house. All those are personal in nature. We cannot say that they are, because he is staying in the house, he is getting benefit of that, we can claim the credit. That is too far-fetched.
So it means that benefit is all, if it is the benefit for the expense, if it is claimed only for the director, then it is a company expense. If it is the entire family, then it is not.
Ideally, unless the family also are directors.
So what I see is
Then in that case, residential for the director family, then ITC is ineligible in that case.
Yes.
if it is for furtherance of business, then it can be claimed.
Yes.
Not for
So
furtherance.
basically, we need to prove
It's a
furtherance of business. It is a business expense.
Yeah.
So if it is being used for my employees, it can be taken. In service tax, there was the case law which said in relation to these townships, where say mines were being made, so they made townships around those mines. People could not stay other than in the township. At that time, the credit of even those areas were being provided. But now the same analogy cannot be applied in GST. Because first of all, GST, the credit definition has been made wider than it was in the erstwhile law. So taking that same case law telling, see that time only when it was impossible for them to stay anywhere else, that's when the credit was enabled. In this situation, you are staying in Jayanagar, office also is in Jayanagar. It's not that you have to provide this as a expense, and therefore we will disallow. That is my business law. So to that extent now the scope of the input definition has widened, and I think we can be safe under the furtherance of business if we are able to prove it's a business expense.
If employee is deputed from outside country,
SCM.
Which is
if employee is deputed from outside country to
Okay.
India, and I provided as part of employment agreement, I provided that I will provide an accommodation to him and his family. Then I have to pay RCM residential. Then RCM paid.
So again, when you bring in family, there is
That's
a
all.
dispute.
So the okay. See, I deputed a person for my business help. okay, since he doesn't have a residential accommodation in India, I provided.
Correct.
Then
So there, the issue here is who is it being used by? If it's being used by your employees only, well and good. If it is being used by families, the department can dispute.
No, it can go under schedule 1. It can go under perquisites to the employee.
Yes, it would also.
So employer-employee, anyway it is outside the scope of supply itself.
Yes. We can take that view.
Yeah.
We can take the credit also here.
Yeah.
But when it is disputable in nature, we have to think about it. Generally, service apartments are being taken by companies. Generally, it is for employees. You cannot go and stay with family over there. Generally. But in these cases where it's deputation nature, it may be some possibility may be there. We need to think
here the
about
scope of
it.
section schedule 1 will never come, sir, because service between employee and employer, if there is,
Correct.
but I was talking a residential accommodation taken in the name of the company and provided to the employee,
Correct.
and RCM is applicable. Whether that RCM paid is eligible for credit or not.
So credit claim is still, there's a possibility to dispute. What sir is telling that value also then come part of the perquisites. Why should we dispute it when the expense is allowable in nature? We consider that also as business expense and therefore then claim the credit. That is the way in which it is addressed. But see, the disputability in my view, we have to fight on the basis of why we took those places. If generally it's not that one person will stay forever. Generally our family staying over there, we have to understand. If it is like a service apartment being used only by employees, one time one family went and came and went. We need to have some substance over from concept over there. Yes. Okay.
So in this case, can we take an opinion that the GSTR order does not have the ability to portion the personal expenditure of the expenditure? The fact has been upon the side of the working and we take that.
So what you are saying is it's actually personal in nature, but it's not a change. Yes. So as of based on the documents, it is business expense.
Yes.
So to that extent, as GST auditors, if you feel that it is personal in nature, you can indicate to them, sir, do you want to claim it or not, it's disputable.
But can we take it as now that the fact that this act
You can take that. But see, that will only have a persuasive value. The department officer, if he feels it is personal in nature, you have to prove to him it is not personal in nature, it is for the furtherance of
onus
business.
lies on us, not
Yes, onus will be then back on you. So with respect to ITC, burden of proof lies on the assessor. Next is, we have few common issues and possible solutions. Wrong type of GST, outward supplies due to place of supply misunderstanding. So we can use the benefit of section 77 and 90. 77 under CGST, 19 under IGST. Both of these provide that you need not pay directly. If you pay also, you can ask for the refund of the tax which is wrongly paid, and there would not be any interest liability. Alternatively, it says when it is held to be. So that means when department comes and identifies the transaction, they should then ask for the correct tax and return the incorrectly paid tax without an interest component. So this section 77 and 19 can be used. Very common issue which arises from this is taxes paid incorrectly in incorrect GST numbers. So I was supposed to pay in Gujarat, I paid it in Rajasthan. There is no option for that. You cannot use section 77 in that situation. Liability still remains in that state. In the other state, you have to go for the refund. But whether 2-year time limit applies to that, that can be disputed. Because whenever you have paid something which is not in the nature of tax, it is deposit for the government. It is not tax. So this is there. Article 265 of the Constitution can be used. Even your section 32, if I am not wrong, of GST law says that a person can only collect tax to the extent that is allowed in the law. So in this situation, if say Rajasthan was supposed to pay, Gujarat has paid. Gujarat, what he has paid to the government is not tax. Rajasthan, what he is supposed to pay remains tax and he has to pay with interest. So refund for Gujarat is possible. irrespective of time limit. Department again will dispute
Any
this.
case law on that?
I don't know the name, ma'am, but it is available because Article 265 can be used.
He said Kerala High Court, they gave judgment, I think so.
Yes, I don't remember the
Related
name.
2 years, there is no rule,
See,
there is no section backup.
section is there, sir. Section 54 is there.
Section 54 is there, sir. But Kerala High Court told that in rule they told that within 2 years you have to apply for refund. But it is not backed by the section. Somewhere Kerala High Court told.
I am not sure, sir. I deal with review and returns. My case law knowledge is a little. Next, we have wrong type of GST under RCM. Here again, benefit of taking this section 77, whether it is possible may be doubtful. Whether it is considered to be wrong taxes collected is the question which is there in the. So it may not be possible. So please make sure RCM is paid correctly based on the traces. Wrong type of ITC which is claimed. Very common issue which is there. Again here, different GSTs, there is no remedy to this at all. There is a loss of credit. If it is within the same GSTN, correction should be made within the timelines. There is no other via media out of this. Applying this section 77 again would be very difficult. Legally can be challenged because the IGST which is collected, 50% goes to the state. CGST also, when you are collecting whatever calculations they have internally, CGST SGST is 50%. So when there is no revenue loss evidently to the location, why is there a loss to me as a taxpayer? This can be questioned, but again, whether law is fair, when we say answer is no, we have to be careful when we are claiming the credits. GST on goods which are not exported, maybe the invoice is made in foreign currency, customer is outside India, but the goods have not moved outside India. Very common in case of the OEMs which make certain tools and jigs in India, use it in India for production, but they invoice the foreign party sitting outside India. In these situations, amortization concept would come into picture. There could be liability issue, how they have structured the transaction, how taxes are being computed needs to be understood. Rule 42 exempt supplies, like I mentioned, high C sales is amended now in Schedule 3. We need to, there are few amendments actually in Schedule 3, where this section says from February 2019 onwards, ITC reversal can be excluded. That means what they mean is from July 2017 till Jan 2019, those transactions which have been prospectively implemented in Schedule 3, which later on became retrospective also, still the refund will not be provided for the previous period, July to Feb 19. Now maybe the time period is passed for raising the refund applications in relation to this. But again, under this Article 265, we can claim if we have made excess ITC reversal, considering these to be exempt supply. Sale of securities is something I missed. So sale of securities, 1% of the sale value. So profit on securities will come in your P&L, but sale value you will have to identify. 1% of that should be deemed to be exempt supply for the purpose of your exempt supply calculation. Common question which is asked, sir, I am doing only taxable supplies and I am also having the sale of investments. Should I reverse ITC? Answer could be no, telling that there is no ITC relating to this outward supply at all. But on a conservative basis, maybe you can take some few common credits like communication, rent. Take 1% of this. On your total turnover, in my view, it will be maximum 1% of your turnover. 1% of this reduced common ITC would be another 1,000 to 2,000 rupees. If you do this reversal, department then has to confirm your working only. They cannot say that you have not done the ITC reversal. So that is one option which can be taken.
Like out of this context of GSTR, this sale of annuities credits, ITC reversal, that amendment came, the explanation 1B to Rule 43 was added with effect from 5/7/22. So, but the exemption for annuities credits was inserted in that agreement. So, is that prospective or retrospective?
So again, question is correct that the duty scripts which are exempted in GST law were part of exempting supply for the purpose of Rule 42, and once it came into the law, it came in by way of explanation, saying that duty credit scripts exempt supply need not be considered as exempt supply while doing this ITC reversal computation. So in the past, again, if I had considered and reversed ITC to that extent, and in the beginning there was MES, SAS related scripts which were there at a higher value. So at that time, the entire value if I had taken as exempt supply, there could be a significant ITC reversal which was performed in those initial 3 years. To that extent, can I go for a refund? Answer is again yes. Because this has formed part of the explanation. This has not come by way of a new rule or a new notification. They have clarified by way of explanation that this also need not be considered as exempt supply. So therefore, I can look at it retrospectively. Dispute? Sure. I think issues in GSTR 9C we have discussed. So do's and don'ts we will focus upon. First and foremost, maintain all your 99C workings with relevant data. One rule which I follow, if a 99C working has come with me where anything in the form is keyed in, I don't accept that working. So very easy practice. It means that everything should be linked to some set of information which then we have to, only thing I need to verify is the source of information. Next, table 8 of GSTR 9 now, 2B versus 3B, please be mindful of it. Spillover transactions have invoice level details. Do not forget to file nil returns where you have multiple GSTNs. So say a new GSTN was registered in January and that entity does not have any outward supplies, no ITC also. There are no transactions for that January to March 24. But you have to file GSTR 99C even for that because on a PAN level you are more than 5 crores. If you forget to file nil returns there, unnecessarily you will be paying the late fees. While filing GSTR 9C, first verify GSTR 9 workings, confirm everything is matching before you file GSTR 9. Do not start 9C working after filing GSTR 9. There could be certain corrections which you need to consider in 9 itself. So what are the departmental issues and solutions with respect to 9C? Major error that they are seeing is your turnover mismatch in table 5A. Other than this, table 14 non-disclosure. This is like a frivolous notice of sorts. It is an relaxed optional table, but they still say that because the total comes in table 14, they are telling there are no details which are mentioned above. So we have to of course give them the details of the notification, which has given the relaxation, and we can say that these are not mandatory tables. Table 5O income has transactions liable to GST. This is their understanding. They are saying that their huge values are sitting in table 5O as an adjustment. So they are very skeptical of that value. One of the best practices we have implemented for table 5O is in the reasons for difference in table 6. We will mention table 5O includes and we will list the entire details. So say it is Ind-AS adjustment 5 lakhs. Then there is say margin value which is on sale of motor vehicle negative 6,000. Like that, each and every entry which forms part of table 5O, if I add all those values, it will give me total of 5O which has been considered. This is a suo motu automated data which we are giving to the department. Later they should not come back and say you withheld information, you have put transactions liable to GST inside this. Check mechanism for me internally. When the team prepares this 5O and gives it to me, I can verify whether there are any taxable entries forming part of 5O. So this is a two-way check, useful for both department and taxpayer also. Table 9 mismatch versus 9C. There could be reasons like I mentioned between the two databases because certain database is not considered while doing the matching between 9 and 9C. 12A matching, which is ITC as per your AFS, which is not matching with the books of accounts itself. there could be reasons. There could be adjustment entries, ITC reversals done by way of DRC 03 not updated in the books. ITC reversal under protest maintained separately. Spillover transactions not considered in the books of accounts. So the common errors which have been identified are listed here. Other two I have provided. These are things which I expect that the department will raise once they are done with raising the basic reconciliation based issues. Once they start getting into conceptual, they will do 7E versus table 9 taxable value matching. They will check 12E versus 12C of last year. These will be things that they will start getting into and verify. So with this, I will conclude my session. Any questions we can take them up now. Sir, is it fine? 5-10 minutes we can take questions.
Sorry, Gavin.
Merchant export. Merchant export. Merchant export. So there is no GSTR. So it is a non-GST.
Merchant export has 0.1% tax on it. So it is a taxable salary.
Now we take, for example, here if you do the outside India, from outside India,
Okay.
so there will be no GST since.
Yes, that's schedule 3 schedule. So that is transaction which is happening outside the country where goods are not entering in. Is schedule.
There is a change here. For example, I will think about outside India. Totally the goods from outside India or outside India. And service provider in India providing service to the outside India.
Okay.
So the service provider to the outside India is supposed to pay to me because I have to give a money to him.
Okay. So, sir, in this case, whether goods have entered India? Service. Okay. So, in this situation, then we will have to see, sir, because service which is not, we cannot say that service has not entered India. So, when you are providing services from India, then taxability would be there, but you would need to see whether you are covered under export or service. So, if you are satisfying those base of supply conditions and you are getting foreign currency, then it is possible that it could be an export or service.
For example, I am here doing the providing the service outside India.
Okay.
For that project, I am getting the material from outside India. Outside India in the sense China to Australia.
Okay.
So,
Yeah.
for performing the project, when I get the service from India to the other party from India to Australia,
What is the nature of service, sir?
so that is IT related service.
IT related
IT
service.
related installation and
Okay. So you are raising invoice from India, IT related service.
yes,
You are raising goods invoice or the service invoice or both?
both.
So for the goods portion which is moving from China to Australia, there is no GST implication. For service portion, there would be GST implication. But again, we can see the agreement and understand if there is an option for optimizing. So my email ID is there. If you have any other doubts, because I am not sure if we can resolve all the doubts here. Yes, sir.
Circular 170.
Yes.
So, circular 170. There is a taxpayer who is not being able to comply. Taxpayer is not being able to comply with the claim and reversal provision for 23-24.
Correct.
So, can there be a situation where the entire reporting is done in the annual return and then he complies?
So in annual return, actually there is no option of permanent and temporary. So disclosing in any different manner in the GSTR 9 would not satisfy compliance of Circular 170. So you are still open to a dispute from the department. The other issue recently we found out was there is one Suvarna Fibrotech decision which says that the general penalty can be applied per instance. Now, per instance, if it is considered per tax period, per return filing, then we have an automated 6 lakh liability for the financial year, which is then large compared to 50,000 So whether department takes that, whether we can ask for waiver, ask for a reduced penalty, we can do that. But compliance seems to be the way out rather than non-compliance.
One issue that came up is after 20th November there was a summons notice, and in the summons notice this point was raised. There's a tax credit of 70 lakhs IGST that is not claimed at first, though it is negligible because it was not done. So the assessing officer is asking us to claim the credit in the November month letter,
Correct.
which is going to be filed in December, and then reverse it. The problem is it's a time barred.
Yes.
Can't claim it.
So here the concept which they are getting under is, we are not asking you to claim the credit as such. We won't question you on claim of credit. You show it only in 4B1. So in the system, what will happen is, say 70 lakhs is the value. DRC 03 automated notice 2B versus 3B will automatically come out because that is more than 20% and more than 25 lakhs. So in this equation you will probably satisfy both the conditions, and therefore you will get DRC 01C. You will have to reply under others telling that this is a requirement of the department. I have claimed in reverse, there is no benefit that has been accrued out of this transaction. That's all. As far as I have seen, DRC 01C, whatever you reply, they are accepting. I have not seen another response again towards the response which is being made. But during audit, whether they can take the document what you have provided as a response, use it as evidence, 100%. So if you give some bogus reason, later they can come and tell this is not acceptable, you pay the tax. But what he is asking you to do does not impact claim. When I say claim, it is 4C. Otherwise, all those temporary reversals which we maintain and then reclaim, how can I claim for the second time? It's not eligible. I already claimed first time in my 485. So then the concept itself will get done.
Should we show that there was an option to update opening balances of items?
RCM,
Yeah.
yes. ECRRS.
Yes. To the extent we have not shown the auto-populated ITC as per 2A
Yeah.
and 4A, where we have not followed the procedure, they gave us a one-time opportunity to report the opening.
Correct.
Should we report that anywhere in main? Because
No. Please don't bring it into GSTR line. That is only for database which is up to August 23. So up to July 2023, the opening balance has to be considered based on this change. So August 22 to July 23, this permanent temporary issue was there. Now system from August 23 onwards is automatically computing your ECRS balance, which is your 4B2 minus 4D1. So what they have said is, if you are going to disclose anything in 4D1, which is for the period prior, before July, put that as the opening balance, because then your balance becomes negative. For a person who is not followed this process at all, there is no requirement of a disclosure. Person who has followed requires to consider these disclosures. There is an article on this concept with the computation format in CA Club India. So you can have it. So we conclude the session. We are past our time also. Thank you everyone for making it interactive. I would like to thank sir. I think Pramod sir also had asked you whether this time also you will take up the session. So I was very happy to do so. So thank you ICA for giving the opportunity. Hope next year also I come, sir. So thank you. The book which is on the table is the compliance and the GSTR 990 book, which is applicable for this financial year also. So all the best and happy 990 season.
Thank you, Akshay, for that wonderful session. I think most of the doubts regarding 990 has been clarified by Akshay. And if you have further questions, you can mail him on the email ID as given. May I request CM M, Vice Chairman of Bangalore branch, to give Akshay and Momento as a token of appreciation for Bangalore branch.